I think anytime you raise rates at the fastest pace in history, it's pretty likely. I'd say 80, 90%. And every time there is a recession, people before it always say, we're going to have a soft landing. There's going to be no landing. I mean, they were talking about that in 06, 07. They're saying, it's going to be soft landing and look what happened. So I think it's pretty likely.
Hey, everybody. Welcome back to Whiteboard Finance. My name is Marko, and I'm here to help you master your money and build your wealth. In today's video, we're going to be talking about how a recent Deutsche Bank study actually is showing 4 red-hot recession indicators. I only believe there's about 3, but we'll talk about all 4 of them in this presentation. So this is called These Recession Indicators Are Red Hot, presented by me. So let's take a look at this first slide. So there's simply too many variables to discuss when talking about predicting a recession. So obviously predicting a recession is very hard. We have things like the war in Ukraine or COVID-19, for example. However, Deutsche Bank, according to them, they're saying the likelihood of a U.S. recession is 100%, and they're warning of another unpleasant and unavoidable American boom and bust cycle. So to back up their forecast, a Deutsche Bank team led by Jim Reed, he's the head of global economics and thematic research, is basically saying they've analyzed 34 different recessions going all the way back to 1854, and they highlighted 4 key macroeconomic triggers that have caused recessions in the past. So for each trigger, Reed and his team, they calculated a historical hit ratio, or the percentage of times when these events occurred that led to a recession. So you'll see in the next slide right here, anytime you see a percentage right here, that is that hit ratio. So we've had 11 hikes from 0% to 5.5% in the last 1.5 years. So these rapidly rising interest rates, they correspond to recessions 69% of the time. So as you can see here, March 17th, 2022, we were basically at ZIRP, which is zero interest rate policy, and now we're at 5.5%. Just about a year and a half later in September of 2023. So in the U.S. since 1854, when short-term interest rates have risen by 2.5 percentage points over a 24-month period, there has been a recession within 3 years around 69% of the time. So just to show you another chart here, you can see how rapidly these have increased. So that red arrow is March of 2022, and you can see how steep this staircase is. It doesn't even look like a staircase. It looks like an elevator. So if you look at the early 2000s, that was the dot-com bubble. If you look at the mid-2000s, that was the great financial crisis. And then you can see we basically had ZIRP for 8 years. They slowly started to hike until the market crashed in December of 2018. They slowed down, and then we had COVID, which is 2020, and then we had zero interest rate policy, which brings us to March of 2022, and you can see how steep that incline is. So number 2 is rising inflation. You can see here 77%. So this is by far the most concerning of the 4 recession signs. So Deutsche Bank finds that a 3% rise in inflation over a 2-year period triggers a recession in 77% of the cases. So the Consumer Price Index, or the CPI, in the U.S. increased by 3.7% year over year to 307 points, which you can see where my cursor is, in August of 2023, which was an acceleration from the 3.2% growth recorded in the previous month. So in this next slide, you can actually see the government-provided CPI. This is the U.S. Bureau of Labor Statistics, and you can see that basically inflation went from 9.1% in June of 2022 down to 3.7%, where the red arrow is. So although it's fallen dramatically over the past couple of years, or actually over the past year and a half, if you will, you can see that all these check boxes in the previous year or two has actually been met. So again, since 1984, 3 percentage point rise in inflation over 24 months predicts a recession 77% of the time. And what a lot of people need to realize is, real quickly, this country runs on debt, okay? So it's going to be super sensitive to rate hikes. Not only does it run on personal debt, we have credit card delinquencies and also credit card balances at record highs, corporations as well. So we're going to get into the next 2 indicators here, but before that, let's get into a word from our sponsor, Policy Genius. My wife and I decided to get life insurance through Policy Genius after we had our first child over 2 years ago. We just recently had our second child, and we have such peace of mind knowing that they're taken care of with our term life insurance policy. We both travel a lot overseas, and if anything were to happen to us, we know that our girls won't go through life at a financial disadvantage simply because of the financial steps we took to get our term life insurance from Policy Genius. Getting started with Policy Genius is simple. We filled out our information on the website, we talked to their licensed agent, we answered all of her questions, and she got back to us with quotes that made a lot of sense financially and also covered our needs from a product fit standpoint. So even if you already have a life insurance policy through work, it may not offer enough protection for your family's needs, and it may not follow you if you leave your job. With Policy Genius, you can find life insurance policies that start at just $292 per year for $1 million of coverage. Some options offer same-day approval and avoid unnecessary medical exams. Policy Genius knows how valuable your time is. Their technology makes it easy to compare life insurance quotes from America's top insurers in just a few clicks to find your lowest price. Their licensed, award-winning agents can help you find the best fit for your needs. They work for you, not the life insurance companies. That means they don't have an incentive to recommend one insurer over another, so you can trust their guidance. Policy Genius is for parents, caregivers, and anyone else who has people who depend on them. They simplify the process of getting life insurance so you can protect the people you love. No wonder they have thousands of 5-star reviews on Google and Trustpilot. Your loved ones deserve a financial safety net. You deserve a smarter way to find and buy it. Head to policygenius.com/whiteboardfinance or click the link in the description to get your free life insurance quotes and see how much you could save. Okay, thank you for sitting through that spot. It helps pay the production costs of this channel. So number 3, I've been talking about for many months now. I actually have a video back in February talking about the inverted yield curve. So again, note the percentages here. So real quick, before we actually show you what the inverted yield curve is, you have to learn what it is if you don't know already. So an inverted yield curve is when interest rates on short-term loans are higher than those on long-term loans of the same risk profile. So typically for this which you'll see in the next slide here, we typically take the 2-year treasury versus the 10-year treasury, and you'll see that shorter-term treasuries historically shouldn't be yielding higher than a longer duration of the same risk profile, but you can see here that an inverted yield curve correlates with recessions in 74% of the cases studied by Deutsche Bank, and notably, it actually rises to 79.9%, which you can see right there, if only recessions since 1953 are taken into account. So we've had an inverted yield curve, you can see this red arrow here, since about June or July of 2022, and again, I've already done a video on this, but I want to show you this very quickly. These gray bars, just so you know when you look at these charts from the Fed, these represent recessions, okay? Shaded areas indicate U.S. recessions. So if you look at inverted yield curve, starts right here, you know, a year later, recession. Starts right here, recession. Starts right here, recession. Starts right here, recession, so on and so forth. So you can see here that we're actually tightening very rapidly, and I'll get to this at the My Thoughts portion end of the video, so stay tuned for that. But you can see here we've been in an inverted yield curve for about a year and a half now, and you can see how quickly we're coming back up to zero, which is not necessarily a good thing. And then finally, this is number 4, it's soaring oil prices. So Brent crude oil prices, they soared roughly 30% since June to over $94 a barrel. This one is not as bad as it seems or not as bad as it looks. Yes, oil is higher, gas is higher, everything's higher, and also there's a lot of stuff going on with Israel and Hamas right now, which is actually probably going to lead to more upward pressure on these prices. But basically, Deutsche Bank found that oil price shocks are less likely to signal recessions than other macroeconomic triggers, at least in the USA. So when oil prices have spiked 25% over a 12-month period, the U.S. has experienced a recession 45.9% of the time. So here's the thing, guys. With geopolitical stuff going on, I'm not going to turn this into a geopolitical lesson. There was an attack like this about 50 years ago on the same holiday in 1973. And just looking at those headlines and looking at that research, oil prices did spike. Right now, Israel and Saudi Arabia, who's typically a big exporter of oil, their relations have actually never been better. But what you can see here is that Brent crude futures surged more than 3% to above $87 per barrel on Monday at the time of this recording. recouping some losses from last week after a surprise attack by Hamas on Israel over the weekend, which started a conflict in the Middle East. You can see U.S. gasoline stocks rose the most since the first week of 2022. But you can see here that high interest rates and slowing global growth has also clouded the demand outlook. So again, are we going to see slowing demand because of this? I don't know. There's also stuff going on in Russia and Ukraine, which we talked about in the very beginning of this presentation, how you can't necessarily predict these recessions all the time. So before I get into my thoughts, I just want to show you very quickly Whiteboard Finance University. We're very proud of what we built. We're at about 90 members right now. People are giving us incredible feedback every day. So if you don't know what this is basically an exclusive online community. It's a financial membership. Think of it like a gym membership. You get access to everything inside the community. We have full courses, live streams, live chat. It's just a full-blown community at this point, which I'm very proud of. But our main pillars, our wealth builders, are how to manage your money, how to increase your income, which you can then invest into stocks and real estate. So these are our 4 learning paths and our 4 pillars of wealth. Again, it's a gym membership. If you want to get 20% off your membership for the lifetime of the school, use the code UHOH20. So that's UHOH20, okay? So let's get into my thoughts. So again, we're at a point where the inverted yield curve is tightening pretty rapidly, going back to 0. And I'm thinking a lot of the glue that's holding all of this together is low unemployment. So again, you have to take that with a grain of salt. It's just like taking the government-stated CPI numbers with a grain of salt. Everyone knows that the CPI is not 3.7% or whatever that number is. If you've been to a grocery store, if you've been to a restaurant, if you've been anywhere, if you're looking at housing prices, rent increases, obviously it's going to be way higher than that. So technically it's 3.7. We all know that it's higher. Unemployment, I believe, is like 3.8 or something right now. We all know that they don't count for people that stopped looking for jobs and things like that. But based on the stated numbers, I still feel like low unemployment is the glue that's holding everything together. Again, as I mentioned earlier, credit card balances are at a record high. If you look at mortgage prices, they're at like 20, 30-year highs, which I have a video coming out on that as well. And then also if you look at just the affordability of everything, I feel like the middle class is getting kind of crushed right now. So basically, if we have higher unemployment or if layoffs start to happen as they did last summer in tech, but if that follows into some blue-collar parts of the country, we're going to see a lot of these things start to unravel. Again, this is not a fear-mongering channel. I'm just commenting on what I'm obviously observing in my own life and also based on all the feedback from you guys, the news, and just real-life anecdotal evidence. So as always, I hope you got value out of this video. If you did, please hit the like button, hit the bell notification, and share it to a friend. Hopefully they can get value out of this as well. And also check out Whiteboard Finance University down in the link below. Thank you so much and have a prosperous day. All right, I'm calling Nate O'Brien. Let's see what Nate O'Brien has to say about this.
Hey, Marko, what's going on?
Nate, Mr. O'Brien, how you doing, buddy?
Great.
Great, you sound excited. Hey, so real quick, I'm doing a video on these recession indicators. Basically, in a nutshell, Deutsche Bank is saying rising interest rates, rising inflation, inverted yield curve, and the price of oil going up. Those are their predictions for a 100% occurrence of a recession. What are your thoughts on that?
I mean, I think anytime you raise rates at the fastest pace in history, yeah, I mean, it's pretty likely. I'd say 80, 90%. And every time there is a recession, people before it always say, you know, we're going to have a soft landing. There's going to be no landing. I mean, they were talking about that in 06, 07. They're saying, you know, it's going to be soft landing and look what happened. So I think it's pretty likely.
Yeah, I just pulled up a slide, and Nate did not see this, you guys, but I have a slide in this presentation. When you look at like how much they've hiked since basically March of 2022, I believe, it just looks like an elevator. It doesn't even look like a staircase. So I would have to agree with you there. I think a lot of this country runs on interest rates and debt, and I think that's the lever that kind of breaks everything. So thank you for that insight. Real quick, final word: soft landing, hard landing, no landing, crash landing. What are you thinking?
I mean, it just depends what's going to be the thing to break. I mean, it's probably not going to be, you know, single family like home mortgages, because those are all on fixed rates. At least on the consumer side, it might be whoever's holding the bag on all those. But probably commercial real estate maybe would be my guess, or something breaking in a different country like in Europe where they have adjustable rate mortgages. So it's too difficult to tell.
Got
really.
it.
But I think inflation's here to stay for the next decade. Regardless of recession.
Decade, okay.
Regardless of recession.
Higher for longer. So yes, we've talked about that inside of my community, but yes, higher for longer. I agree with you. All right, brother. Thank you for your input. Have a good one.
Yep.
All right. See you, Nate.